All right, on today's video, we're gonna be talking about mortgage payments. And time again, I help a lot of first-time home buyers, and a lot of people think about how much they can afford in a completely wrong way. And they focus too much on purchase price. And in this video, I'm gonna debunk why that is the wrong strategy and why there's a lot more effective way to think about how much you can afford for your new home. Welcome back to the channel. My name is Jordan Pyle. I'm your go-to Chicago realtor. If you have any questions about buying a home in 2022, just feel free to hit the link down below to schedule a real estate strategy call, and we would love to help you out. But without further ado, let's dive on into the video. All right, so I've been selling real estate now for the past 8 years downtown in the city of Chicago. And when I'm talking to first-time home buyers, or any buyer for that matter, but mainly first-time home buyers, a lot of times they come to me and say, hey, Jordan, I think that I want to buy a place for $500,000. And while this is a good framework and kind of a good reference point, the reason that this is not an effective strategy is because there's a lot of different things that go into your monthly mortgage payment. So just solely relying on purchase price is often going to lead you to a situation where maybe you're looking at things that you can't afford, or possibly looking at things where maybe you can afford a little bit more, and you've just been focusing too much on the purchase price instead of actually thinking about it in a way that I often recommend to my first-time home buyers, which is this. You want to focus not on purchase price, you want to focus on what is the monthly mortgage payment every single month that you're going to be comfortable paying. And oftentimes I see that when people get pre-approved by a lender, if you need a good lender, I have several that I can refer to you. Again, feel free to reach out down below and I can put you in touch with a great one. But the reason for this is you essentially want to factor in all of the different pieces that make up your mortgage payment. If you just focus on the purchase price itself, this is often going to lead you in the wrong direction. So let's dive on in. What makes up your monthly mortgage payment? I'm going to put it on the side of the screen here next to my face somewhere in this area. But we use an acronym, a helpful acronym called PITIA. The P standing for your principal, the first I standing for your interest, your T standing for taxes, your I standing for your homeowner's insurance, and then your A is your homeowner assessment or your HOA dues. And there is one final kicker here that's gonna go in towards your monthly payment depending on how much money you're putting down, and I'm gonna save that for the end. So the reason that this is super important that you focus more on this monthly payment that you're comfortable with, so let's just use the example of $3,000 a month. Right? So maybe you know that I feel comfortable every single month with an outflow of $3,000 for my housing expense. And essentially the big pieces of this that are going to make up this equation of your monthly payment, the P and the I, so your principal and your interest. So things that go into your P and I, or your principal and interest, are things like what your credit score is. So do you have a good credit score? Is it an average? Is it excellent? Typically I see anything above like 640, 680, you're typically going to have access to the best rates that are out there. But that's just one factor that will go into what your overall principal and interest is. And other things like your debt to income ratio, typically most banks don't want to see that you have more than 40% debt to income. So if you sum up all of your minimum debts on a monthly basis, divided into the amount of income, the lender won't want you spending more than about 40% of your total income on a monthly payment for a home. And lastly, things like your cash reserves, and most importantly, the interest rate is going to determine your overall P and I in that equation, the PITIA formula. Usually this amount is going to make up a large sum of the total monthly payment, but we forgot that there's also the T, the I, the A, and then an additional I, which stands for insurance, which is basically your principal mortgage insurance if you're not putting 20% down. Again, we'll go into that a little bit more at the end of this video, but let's dive on into why I want people to focus on their monthly mortgage payment instead of a purchase price. And the reason for this, especially in the city of Chicago, where we have a lot of high-rise buildings and a lot of different buildings that have varying taxes and assessments. So if you're buying a single-family home, you might not have a monthly homeowner's assessment. You typically are gonna have your PITI, which is your principal, your interest, your taxes, and insurance. And we add in the A, which is the homeowner assessment, because a lot of times we have condo associations here in the city of Chicago. So the reason that this is important is because your taxes and your assessments often fluctuate very, very drastically from property to property. So if you're just gonna solely focus on purchase price, you're not taking into consideration what those amounts are. So in some areas throughout Chicago, you might have higher tax rates, or potentially a building that maybe has more amenities, or it has a full-time door staff, and maybe it's a little bit older and it requires a little bit more routine maintenance. So all of these things are gonna increase your monthly assessment that you're gonna have to pay in order to own that property. So sometimes I see that people are looking at one property property where, let's just say, for example, it's $350,000, but it's got a really, really high assessment and a really, really high tax, that's going to limit your purchase power, because all of those things combined, your PITIA, are essentially going to add up, and it's going to tack on an additional amount every single month for your annual tax bill, which you divide by 12, and then plus your monthly HOA due. Where on the other side of the coin, you might be looking at a $500,000 property, but it has a very, very low assessment and it has very low taxes. And just because of that reason, it could be that your monthly all-in payment is very similar, even though you have $150,000 more in a purchase price. So I hope that makes sense on why just principal and interest and purchase price alone, you cannot just take that in consideration, especially in an urban market like Chicago. So something that I recommend is basically getting a handy dandy mortgage calculator. And when you're looking at properties online, whether it be in different search platforms like a Redfin or my website, if you want a link to that, there's a link down below. You can go and search for homes there. You can reach out to me directly through that website as well. But you want to essentially crunch the numbers. So you're always going to have a pretty standard principal and interest, but then based on that specific property, what you're going to do is typically you're going to see the annual tax bill. So all you need to do is take that annual bill and divide that by 12 and then add that into your principal and interest. So now you're covering the P, the I, and the T. And then your insurance, you can just take about $25 to $50 a month conservatively on average. Depending on the property, it might be a little bit more, it might be a little bit less. But let's just say $50 conservatively for that second I. And then your monthly assessment is going to be stated from a monthly standpoint. So then tack that on, and now you have your PITIA. So if you're putting 20% down, that's typically the total amount of your monthly mortgage payment. However, this is the kicker, this is the part that I said I was going to come back to, is if you're putting less than 20% down, the bank is essentially seeing this loan as a slightly riskier loan. And therefore, they're going to charge you what's called PMI, or principal mortgage insurance. This is typically going to be an additional fee in order to secure the loan, because you're putting less money down, and in the eyes of the bank, you're considered a more risky borrower because you have less equity in the property once you purchase it. So all in, you're looking at your principal, your interest, your taxes, your homeowner's insurance, your assessment, and then your principal mortgage insurance if you're putting less than 20% down. And even if you are putting less than 20% down, there's different ways around basically eliminating that cost, whether you're getting a seller credit, then your lender can apply that and pay that off at closing, or potentially you're putting, maybe 15% down, and for a short period of time, you're gonna be paying mortgage insurance, but then once you reach that 20% equity threshold, that principal mortgage insurance is gonna fall off, which is gonna reduce your monthly mortgage payment. So those are the different reasons that I recommend don't focus on purchase price. Time and time again, I see people getting into the situation, and then they end up down the road looking at the wrong type of properties. So I encourage you highly, highly to just factor in what is the monthly payment every single month that you're going to be comfortable with, and then roll with that, and we can work it backwards. So then when you're going back to your realtor and saying, hey, I decided that this is the payment amount I want to work within, and I need to make sure that my taxes for any properties that we're looking at are under this amount from an annual basis, and then my homeowner's assessment is under this amount. So we're basically putting parameters around your search so that we're looking at the right type of properties, so that you can ensure you're securing a property at a monthly mortgage payment that you feel good about, and that's not going to make you house poor. It's also just going to make you feel good about your overall investments. So I hope this has been helpful. I just wanted this to be a quick hit video defining why it's important to focus on monthly mortgage payment and not purchase price alone. So if this video has been helpful, please leave a like, comment down below any additional questions you have about your monthly mortgage payment, and before you go, be sure to hit the subscribe button on this channel so that you can catch all of our future videos. Take care, and we'll see you on the next video.